Before we get started, I want you guys to take the opportunity to give yourselves a round of applause for taking command of your future with the use of accounting information and chasing the bags. So, at this point, we should already be familiar with what financial accounting is. It's basically a process that records and reports information in order for people to make decisions. Now, we're going to focus more on the recording aspect. But before we go in detail with the recording aspect, we must investigate two major things that help solidify proper, accurate accounting recording information: the ledger and the journal. So, let's talk about what's the ledger. Well, consider back in the days when we had books and we wasn't as computerized as we are now.
Hey, 1995 call.
The ledger used to be a book of all the accounts. So remember, we have several different types of accounts. We have asset accounts, we have liability accounts, we even have stockholders' equity accounts. We also have accounts that affect stockholders' equity, particularly retained earnings. We know that to be those income accounts, which consist of revenues and expenses. And we also know retained earnings is affected by dividends. So any possible account that you could think of that affects your business would be inside of the ledger. Now, what is the ledger's main responsibility? To keep the accurate effect of each account and its balances. So, let's take a look at an actual ledger so we can really understand what it entails. So basically what you're looking at right now is an example of how the ledger is formatted. Two sides in every account. We have a left side, which is considered the debit side, and we have a right side, which is considered the credit side. Now, what I like for you to do, gang, is leave whatever idea you have for the word credit when it pertains to accounting outside the door, okay? Basically, in accounting, credit just simply means the right side of the ledger, okay? And so what this example is just called, you're gonna hear that word a lot, a T account. So every account, whether it's cash, accounts receivable, common stock, all has its separate T accounts within the ledger. So this example that we're looking at obviously is cash, right? So we see the name of it right here, cash. So this is an asset account. And basically each account has its own left and right side of the T account, right? And so from the previous illustration, we saw that the left side is your debit side and the right side is your credit side. We have several different transactions that have affected cash for the month of January. Obviously, we have the exact dates of those effects on cash. Since cash is an asset, it increases on the debit side. And so from this observation, we could tell on January 3rd, we had an increase in cash of $10,000. We see that January 6th, we also have another increase in cash of $3,600, and so on and so forth. Anytime that it is decreased, it will decrease on the credit side. Well, clearly we know on the 5th of January, we had a decrease in cash for $550. Now let's scroll all the way down to the end of the month. We also see that we had a what? Another decrease in cash for $1,000. And so this is the perfect example of how a ledger performs from a recording standpoint, because it allows us to take a quick identification of each account and we can find out what things have affected it, how has it been affected, and we can find out the ending balances. So if we focus at the very bottom of this particular T account, notice we have a special line that's separated from all the other transactions, and this is simply your ending balances. And this tells us, gang, how much cash we have left for the period of January. As always, gang, I'm truly appreciative of sharing this time with you. And if that light bulb is clicking, please feel free to like, subscribe, or share the channel for more ways to chase bags with this accounting information. See you soon.